Welcome to Basics of Financing in the Real Estate Basics course. As you begin this lesson, consider how the material you have learned thus far is taking you chronologically through initial investment steps. This means that any investor, whether new or experienced, has to do the same things you've been doing in order to initiate a deal. Let's pause to see where we've been. Previously, Jan Eliason and Bob Grimm have taught you how to work with realtors, find and qualify motivated sellers, and establish a target market. They also discussed different strategies to use, what to look for when getting in and out of a house, and how to run the numbers on a property. Wow, that's a lot to know. At this point, it's important to keep things in perspective and not get overwhelmed. You don't have to do everything at once. Remember, the action items build on each other, so feel comfortable taking things a step at a time. Also, do yourself a favor and use these lessons to learn from, so you can get out and apply the material, not just plow through to see how many courses you can finish. We understand that some of you have gone above and beyond the call of duty by completing more work than assigned. Good for you. The more you do, the better educated decisions you'll be able to make as an investor. Now, just to make sure you're up to speed, the last action items assigned from the What's It Worth lesson were: 1. Determine seller motivation on 10 properties. 2. Schedule visits to your top 5 properties. 3. Estimate holding and repair costs for the ones you're interested in. 4. Calculate the fair market value and establish your maximum offer amount. And 5. Choose a strategy for each property you want to pursue. Once you've completed these steps, it's time to move forward. In this lesson, Jan and Bob will describe different ways to make money regardless of your current financial situation. They will discuss the differences between getting pre-approved and pre-qualified, also different types of lenders, and finally, the right kinds of questions to ask to get the financing process started. Before you begin this lesson, please take the time to print out the workbook file. Also, have a pen and paper ready so you can take notes on the points you want to remember. Now it's time to get into the basics of financing.
Bob, what do you have for us today in our tips for success?
For today's tips for success, Jan, let's turn to the famous radio personality Earl Nightingale. Mr. Nightingale defined success as the progressive realization of a worthy goal or ideal. The reason I mention this is to remind you that success in real estate investing does not happen all at once. It takes time. And while it may seem like your progress is painfully slow, as long as you are making meaningful progress, you are being successful. Some of the most successful people in the world have focused on the idea of living each day to its fullest in order to build a successful life. If you are accomplishing small tasks every day and continuing week after week, before you know it, you will be living a successful life. So then, how do you live each day successfully? There are 3 things that you need to do. First, keep your goal in mind as often as you can throughout the day. Reinforce in your mind why your goal is important and what it will mean to you when it's accomplished. This will help keep you motivated as well as allow you to see your progress. Second, complete as many tasks in a given day as possible. This does not mean you have to work yourself ragged or try to get the greatest possible number of things done in the shortest amount of time. Rather, it means you get the most important tasks done and done well. Although efficiency is important, it's not the number of tasks that you do in a day again, it's the outcome which is achieved that counts. In time, though, you will find yourself being able to complete more tasks more efficiently each day. As you know, Jan, money is typically a major concern for new real estate investors. Many people know they can find good deals, but they don't have the money to purchase them. Often new investors do not know how to get the needed financing, so they let good money-making properties pass them by. We want to make sure this doesn't happen to you. So first, let's identify where you are right now in regards to finances. There are 4 main categories of personal finance. The first group includes those who cannot make a down payment and have poor credit. Second are those who can make a small or moderate down payment, but also have poor credit. Third are those who can make a small down payment and have good credit. And finally, those who can make a good down payment and have good credit as well. It may surprise you, but regardless of which of these categories best defines your situation, you can make money in real estate. So the question becomes, as an investor, do you need to worry about financing? The answer is no. If you find a great deal, you can find the financing to make it happen if you have done all of the necessary legwork. We will teach you what legwork to do and how to do it in this lesson.
As you know, Bob, it is not uncommon for many of the people we introduce to the world of real estate investing to be in a situation where they have no down payment and a bad credit score. They think that real estate investing is hopeless, but the fact is there are actually many options available. One of the options that does not require any money at all is to find properties for other investors to purchase and collect a finder's fee for doing so. As you recall from Lesson 3, this strategy is called bird dogging. Another option we discussed is to find a property and assign the contract to another investor. To make this strategy work, you need to get a property under contract at a wholesale price, then assign it, or transfer the right to buy it, to another investor for a higher price. You then keep the difference in price. A third option for investors with no down payment and bad credit score is to enter into a joint venture with a money source. In this strategy, you find a person or group of people who have money to invest, and you enter into an agreement with them that they will supply the funds necessary for the purchase and possible repair of the property. You then become responsible for finding profitable deals, getting the property fixed up, then reselling or renting it and splitting the profits with the money source. You can also consider asking for seller financing when buying a property. As you recall from Lesson 2, seller financing is when you have the seller or private investor act like the bank for you. In some cases, they will finance the whole purchase amount or require a small down payment and carry back the rest of the financing. You could also obtain a first mortgage from a lender for a portion of the purchase price, and then have the seller create a second mortgage that, combined with the first, totals the full purchase price. No matter which way you structure it, you, as a buyer, will make payments to these people as agreed in your contract with them. Be aware that if you have no down payment to offer the seller, it will be much more difficult to get the seller to agree to carry financing for you. It is not impossible, but it is a higher risk for them, so they will be very cautious. As a fifth option, you could use hard money lenders. Hard money lenders are people or groups of people who lend money at traditionally higher rates than lending institutions. In exchange for higher rates, they typically have less stringent requirements for who they will lend to. Later in the course, I will return to talk more about hard money lenders and how they work. You can make notes of these different techniques and the ones that follow in the Categories of Personal Finance section of your workbook.
So what if your financial situation is a little better than the one Jan just described? Let's say you have a down payment of between $1,000 and $3,000, but still have bad credit. You have some additional options to choose from to jumpstart your real estate investing business. With this amount of money available, one of the best strategies to use is a lease option to gain control of a property. As you recall from the What It's Worth lesson, with this strategy you lease the property with an agreement to buy it from the seller at a locked-in price at a later date. This is the option to buy. In most cases, the amount of money required for the down payment is very small. You continue to make payments to the seller until you can sell the home, fix it up and sell it, or lease option it to someone else. If you are fixing and reselling the property, it is in your best interest to sell it as quickly as possible in order to keep your holding costs down. In some cases, lease options are not feasible because the seller wants the mortgage to be paid off in full immediately. In many investments, you will not need to use any of your own money. However, sandwich lease options are perfect. Sandwich lease options are similar to traditional lease options, but they differ because you're not actually buying the property until your tenant is ready to buy from you. In this strategy, you're considered the middleman in the transaction as you pass possession from the original owner through you to the tenant buyer. When you lease option the property to the tenant buyer, you will also ask for a small down payment. This payment should be large enough to recapture your own down payment as well as some of your holding costs. To maximize profits on a sandwich lease option, Ideally, you want it to remain in place for 1 to 2 years before your tenant exercises their option to buy. Ultimately, however, local laws will dictate the feasibility of this effort. In some states, you can't leave a lease option in place that long.
Before we go on, Bob, I just want to reassure people that they shouldn't worry if they don't know how to implement these strategies yet. We will go over them in great detail in a later lesson. Now, moving on, if you have a little more money available, say between $3,000 and $5,000 to use as a down payment, then you have a little more flexibility in your investing options. In this case, you are still able to do lease options and sandwich lease options, but you also have the ability of working with small groups of investors. This strategy helps spread financial obligations and risk around to the various members. There are 2 ways you can structure working with small investor groups. The first is where everyone in the group is involved with everything. Everyone helps finance the property, everyone helps find it, fix it, and sell it. This is a good option if no one has a lot of money, but everyone has similar goals. The second option is where you select a group of members who are specialized in certain areas. For example, one member may have more money to contribute, someone else may have repair skills, and another may have marketing skills. This is a good option if you have a specific skill but not a lot of money. A final option, if you have a little more money to put down, is to obtain seller financing when purchasing a property. It will be easier to get a seller to agree to carry a loan for you if you have some money to offer them for the risk they are assuming in you by offering you financing.
With the recent changes in the lending world, it has become increasingly difficult to get a no-money-down loan. It is not impossible, as some will say, but you will need to be resourceful and more creative. However, it is a lot easier if you have a down payment available, even if it's a small one. I will talk more about traditional loan programs that only require 3 to 5% down later in this lesson. Knowing these loans are available opens your investing options even more. Don't forget, there are plenty of creative ways to buy a property for very little or even nothing down, but you will need to understand how to execute them. We will teach the ins and outs of these specific techniques in the financing course. If you have a small down payment, you are a stronger candidate for lease options and sandwich lease options. You also have more negotiating room if you are seeking seller financing, and you have more to contribute to attract small groups of investors. In addition, with at least a small down payment comes the possibility of buying properties at auction or through the pre-foreclosure process. Buying property during the foreclosure process or at a foreclosure auction requires a bit more knowledge and resources, but it can be a very viable option. These strategies will be discussed much more in depth in later sessions.
If you find yourself in the situation where you have good credit and a good down payment, then the options are essentially limitless. There is no reason why you will not make money investing in real estate. Lenders typically consider anything between 10 to 20% of the purchase price a good down payment. When you are in this situation, all of the previous strategies for investing are available, in addition to a few others. In the upcoming financing course, you will learn more about these other, more creative techniques to obtain financing to buy properties. Each of these options provides unique benefits and will be discussed in much more detail in later lessons.
If you are credit challenged and money isn't available for a down payment, or the other strategies mentioned won't work for you, don't despair. There are other options available. You could focus on buying less expensive investment options with personal or business lines of credit. We will discuss these lines of credit later in the lesson. Mobile homes are a great way to invest in real estate with very little money. They are significantly cheaper than single-family homes, and often people are looking somewhere inexpensive to live. Frequently, you can buy mobile homes from the mobile home owner for literally pennies on the dollar. Then, depending on the mobile home, you can either resell the home or rent it out and cash flow it. Buying mortgage notes can be an excellent way to turn a profit with little money. With this strategy, you find someone who is receiving payments on a loan involving seller financing, and ask them if they would be willing to sell the right to receive payments on the loan in exchange for a lump sum of cash now. If they agree, you pay them pennies on the dollar and begin receiving payments complete with interest until the loan is paid off. Many times people will be willing to sell a $10,000 loan, for example, for only a few $1,000s, just to have the money now as opposed to having to wait for it. Another small dollar, high return investment strategy is to purchase tax lien certificates. This strategy will be discussed more in depth in a future lesson, but essentially, it consists of purchasing the rights to a property by paying someone's back taxes on the property. Since the city or county is currently receiving nothing on these back taxes, they will typically sell them very cheap to interested parties. If you want to purchase this option, you should check with your local county clerk to see exactly what purchasing the tax lien entitles you to in terms of the amount of the interest rate or property rights, as it varies from state to state.
Now let's talk about two financing terms you need to be familiar with, especially if you're going to apply for traditional financing. The term pre-approved carries some weight in the investing world. It means that you have gone through the loan process and received a specific quote on what interest rate and loan amount the lender will provide. The quote is based on financial information you provide the lender, including your debt-to-income level, your assets, and your credit score. Lenders also use the term pre-qualified when referring to a buyer's loan status. Being pre-qualified is less desirable than being pre-approved because it is simply an estimate of what the lender thinks you are qualified for based on an evaluation of your credit score. Typically, these estimates are pretty accurate, but they do not hold as much sway in investing as being pre-approved. So, if you have the choice of getting pre-approved and pre-qualified, take the extra time and make the effort to get pre-approved.
As you suggest, Jan, a person's credit is a very important component in the loan qualifying process. Credit scores can range from 300 up to 850. Lenders like to see credit scores of 750 and above. The specific score comes from special calculations designed by Fair Isaac Credit Organization, commonly referred to as FICO. FICO uses a proprietary scoring system to determine your overall credit score. There are 3 major credit bureaus in the United States that creditors can report information to on you. The bureaus are Experian, Equifax, and TransUnion. The scores from each of the bureaus are determined by information they receive from your creditors. You may have noticed from your own credit report that the scores from each of these bureaus can be quite different.
That's right, Bob. That's because a creditor does not have to report to all 3 bureaus. You might have 5 creditors reporting to Equifax, 3 to TransUnion, and 7 to Experian. Since each has a different number of creditors reporting to it, each records a different score. FICO computes an average of the 3 in what is often called a tri-merge score. Your FICO score affects how much a lender allows you to borrow and at what interest rate. The higher your score, the better the rate you get, and the more credit you are offered. Here's an example of what I mean. Using today's national standards, let's say you apply for a $150,000 30-year fixed loan. If you have a FICO score of over 750, you could pay $344 less per month than someone with a FICO score of less than 650. That is a difference of $4,128 a year. As you have seen in this lesson, $4,000 is enough to begin another money-making investment. So you can see how important your credit score is.
Now that you've learned about credit and how it affects financing, let's look at some of the sources through which you can obtain money to invest. There are 2 categories of lenders, conventional and unconventional. Conventional lenders have federally imposed rules and regulations they need to obey. The terms they offer are partially mandated by the Federal Reserve Bank. These regulations maintain balance in the lending world by prohibiting lenders from creating their own terms. Unconventional lenders have fewer restrictions on what they provide, they are still ultimately controlled by federal law, but the laws that affect them are less stringent. This means there is more flexibility in their terms, but little consistency from lender to lender. Other options we will discuss in terms of money sources are lines of credit and home equity loans. Both conventional and unconventional lenders can provide these in certain circumstances. Both conventional and unconventional lenders have their place in investing. So Jan, would you get us started with a closer look at each of the conventional lenders and some of the loans they can provide?
Will do, Bob. Conventional lenders include banks, credit unions, finance companies, mortgage bankers, and mortgage brokers. Just about everyone is familiar with what a bank is, an establishment where money is kept for saving, investing, and loaning. A credit union is very similar to a bank, but there are typically specific requirements you need to meet in order to become a member. They are typically nonprofit and distribute their profits back to the members. Because of their membership requirements and being typically less regulated than banks, credit unions are sometimes able to process loans for lower interest rates and be a little more creative. Finance companies are companies engaged in borrowing money, then making loans to individuals and businesses. Unlike a bank, they do not receive deposits, but typically obtain their financing from a number of banks. Finance companies typically enjoy high credit ratings and are thus able to borrow at the lowest market rates, enabling them to make loans at rates not much higher than banks. A mortgage broker is an intermediary who brings a borrower and a lender together. They might have sources of conventional or more creative funding sources for their borrowers. The broker collects appropriate paperwork from the borrower, then presents it to different lenders to get the best rate possible on the loan. Mortgage brokers collect an origination fee from the borrower, or a yield spread premium from the lender as compensation for their services.
One of the most common conventional loans is a fixed-rate mortgage. This is a loan where the interest rate does not change over the life of the loan, and payments are typically made monthly over a set period of time, usually 30 years. You also have the option of obtaining an adjustable-rate mortgage, commonly referred to as an ARM. With this kind of loan, the interest rate is adjusted based on market trends. These types of loans carry more risk because interest rates change daily, and so there is always the risk that your rate will go up. There is space in the Money Sources section of your workbook for you to take notes on these different types of conventional loans.
The Federal Housing Administration, or FHA, has a number of loan programs that conventional lenders offer. In order to offer an FHA loan, the lender has to be federally qualified. This is one of the ways the government can regulate consistency in lending. Some of the FHA programs provide loans for people with lower credit scores and require a small down payment of just 3% or less. An FHA loan has historically allowed lower-income Americans to borrow money to purchase a home they may not otherwise qualify for. One of the drawbacks to FHA loans with the low down payment is that borrowers must purchase private mortgage insurance for loans on which they put less than 20% down. Private mortgage insurance offsets losses for the lender in cases where borrowers are unable to repay a loan and lenders are unable to recover their costs after foreclosure and sale of the property.
Another loan from conventional lenders is the one issued by the U.S. Department of Veterans Affairs, also called a VA loan. The VA loan was designed to offer long-term financing to American veterans or their surviving spouses, provided they do not remarry. The basic intention of the VA program is to supply financing to eligible veterans in cases where more traditional financing is not available. The VA loan allows veterans 100% financing without private mortgage insurance. A VA funding fee of up to 3.3% of the loan amount may need to be paid to the Department of Veterans Affairs and can be financed as part of the loan. The VA may restrict how much you can borrow at any time with its loan. This maximum can vary from time to time, so you will want to check with your VA-approved lender to get the current amount. In some cases, the VA also offers jumbo loans and a loan for non-veterans called VEND financing. It is commonly offered on VA foreclosures and is available to any buyer.
Subprime lending is an option that you might consider if you cannot get other types of conventional loans. Essentially, subprime loans have an interest rate higher than the prime rate. The prime rate is the lowest rate on loans by most of the nation's 30 largest banks. Subprime loans are available to people who have a high debt-to-income ratio or a credit score that is too low to qualify them for a lower rate. Be aware, these loans come and go with trends in lending practices. If there is a conservative focus at the time, they are less prevalent, but in a liberal atmosphere, they can be quite readily available.
Now let's talk briefly about unconventional lenders. There are three main types: mortgage brokers, hard money lenders, and private lenders. Mortgage bankers are individuals or groups of people who lend their private money or money borrowed from another lender. They have a lot of flexibility in their loans since some of the money they have lent is their own, but they are not typically as flexible as hard money lenders. Hard money lenders are individuals or small groups of people who have personal money to lend and are willing to do so with much more flexible terms than conventional lenders. However, in exchange for their flexible terms, they typically charge significantly higher interest rates, anywhere between 12 to 18%, and many require the borrower to pay loan origination or upfront points of from 3 to 10 points. Credit scores are not as important to hard money lenders as is the value of the property being purchased. Private investors are very similar to hard money lenders. They use their own funds to lend on property. These are people who may own a large number of properties and draw on the funds from these properties to continue investing in other properties or have other investments that offer them an ongoing stream of funds to invest. Private investors may charge interest on a loan or opt to share in the profits of the property in addition to the return of the loan amount. You can find unconventional lenders by looking in the classified section of your newspaper under Business Opportunities, Money to Loan, or Loans and Finance. You can also look online by using hard money lenders, money to loan, or private lenders as search terms. Additionally, you can ask people at local real estate investment clubs which lenders are good to work with.
There are two more money options that either conventional or unconventional lenders may be able to provide. The first are simple lines of credit. Lines of credit are financial products that allow a borrower to take advances during a defined period and up to a preset limit, repaying the advanced amount at the borrower's discretion until the advancement becomes due. The due date is set by the lender, and at that time, the advance and any accrued interest is due. This date is referred to as the maturity date. These credit lines can be either personal or business lines of credit. With personal lines, the limit, interest rate, and maturity date are typically going to be based on your credit score. For business lines, the limit, interest rate, and maturity date are determined by the perceived risk the business shows, and possibly with a business credit score called the DUNS number. The lender will ask, is the business potentially profitable? Or is it currently profitable? What assets are involved? And like questions. In many cases, it is a way to have access to a line of credit without it being on your personal credit. Also, you can typically acquire higher lines of credit with your business than with your personal lines of credit. A home equity loan is one in which the borrower uses the equity in their home as collateral. A home equity loan creates a lien against the borrower's house. A lien is a legal claim or attachment against a property as security for payment of an obligation. In this case, paying back the money borrowed. Typically, home equity loans are referred to as second mortgages because they are backed by the value of the property just like a traditional mortgage. Another option that is frequently confused with a home equity loan is a home equity line of credit, or HELOC. The difference between a home equity loan and a home equity line of credit is that the line of credit acts like a credit card with a maximum credit limit, a variable interest rate, and monthly payments calculated according to the balance on the credit line. Both home equity loans and lines of credit can be excellent ways of getting money for investment purposes.
When you are getting ready to talk to lenders, there are 6 questions you should always ask in order to find out how creative they can be, as well as how good they are to work with. There are some lenders who will do almost anything to get you in the door, but then may not be able to perform what they said they could. These questions will help minimize that as well. The first question to ask is, does the lender have any creative financing options for investors? It is important to tell the lender that you are an investor right up front. Be aware, not all lenders are investor friendly. You might get some negative feedback, but that's okay. Just move on to the next one. Also keep in mind that depending on your credit score, the word creative might mean different things. For example, if you have a credit score in the low 600s, it would be considered creative to get you a traditional loan with a decent interest rate for an investment property. On the other hand, if you have a credit score over 750, creative can mean no money down or other forms of attractive financing. The second question to ask is, does the lender have any no money down loans for investors? As was discussed previously, if you are working with a conventional lender, your credit score will factor in immensely here, but not as much with an unconventional lender. So for those of you whose credit scores are low, this is an important question to ask because you will learn if you are talking to a conventional lender or an unconventional one. A creative lender will understand what you mean by this question and may have hard money lenders, private investors, lines of credit and grant programs that they can offer to help this become a reality. The third question to ask is, do you have any 5 or 10% down loans? Again, your credit could be a factor here, especially if you are dealing with a conventional lender. Do you have any no documentation loans? Is the fourth question. A no documentation or no doc loan requires no employment, income, or assets to be stated on your loan application. The lender does not verify any information beyond your credit profile and the value of the property. Some no-doc lenders allow as little as up to 5% down depending upon your credit profile. This is an ideal loan option if your employment is difficult to verify. All you need is good credit, enough equity, and a good property. Another option to a straight no-doc loan is to add employment. This is frequently described as a NINA, or no income, no asset loan. In this case, the lender verifies your employment, but not your income or assets. If you are self-employed, the business must be verified with a business license or similar documentation. If you are employed by a company, your employment needs to be verified, but nothing else. The fifth question to ask is, does the lender allow the seller to carry the down payment and pay closing costs? Many lenders will not allow the seller to take this responsibility simply because of the risk it represents to them as a lender. In their eyes, you are getting into a property with no vested interest. You have put no money into it, nor will you until the first payment is due. So it seems so much easier in their eyes for you to walk away having paid nothing. But it can be a great option for you who have very little money, but have a motivated seller and a good property. The last question you want to ask a lender is, will you lend based on the purchase price or the after repair value? Most times, lenders, both conventional and unconventional, lend according to the current appraisal value. Granted, your actual loan amount might be less than the appraisal according to the agreed purchase price, but few will lend for more than the appraisal. That is why it is important to ask about the after repair value. Some lenders can loan higher than the current appraisal if they know your repairs will add significant value to the property. Commonly, these lenders lend money in outside-the-box deals. Essentially, this is their niche in the lender market. One thing you want to keep in mind anytime you are talking to a lender is to always be upfront with them. Do not try to trick them into giving you a loan that either you can't pay for or you do not qualify for. It only hurts you. Instead, lay all your cards on the table, so to speak, and let your loan professional see what they can do. If you have asked the right questions and made a good choice in your lender, then they can get the deal done the best way for you. The time you took to find and qualify them will definitely more than pay for itself. Your workbook contains these questions along with a lender contact form and a lender interview sheet that you can use to contact and interview potential lenders. You should contact at least 10 to give yourself the best chance to find a couple who will be able to provide the service and financing that you need as an investor.
We hope you've enjoyed listening to Basics of Financing with Jan and Bob. Now that you know something about the world of lending and loan products, it's time to get out and put your knowledge to work. The action items listed here are designed to keep you moving forward in your investment business. The activities and resources in your workbook will also help. This week, focus on the following action items. 1. Identify 3 investment strategies that work best with your financial situation. 2. Locate and contact 10 lenders to learn about loan products and what they may offer you as an investor. 3. Review the questions in this lesson and ask them to lenders you're contacting, and then fill out the lender contact activity in your workbook. And 4. Fill out the lender interview sheet in your workbook and choose 2 lenders you may want to work with in the future. Before you go, please keep in mind that not every strategy requires you to line up financing. You may be using an assignment of contract strategy and would focus your attention on finding buyers to flip a contract to instead of finding lenders. We're confident that by using the principles taught in these early lessons, that you will be better prepared to make offers, which will be the subject of our next lesson. Remember also that everything we've discussed you can actually do. You should expect your business to progress as you get out and work. Jack Kinder once said, "High achievement always takes place in a framework of high expectation." Thanks for listening. We wish you success during this next week as you complete these action items.